All right, so today started off like a little bit of a dud after a news, a good trade rally that ended the week last week. A little bit of weakness today, as we expected. The question is, how much more? Is this enough? How much more weakness? We're in the midst of a pretty decent consolidation. I'm going to show you what that consolidation looks like, and then what the expected breakout would be based on that consolidation. We're going to break that down in today's video. We're going to take a look at what drove today's minimal action. What usually happens in these kinds of very low volume, nothing burger days. And then we'll take a look at a trade idea for a stock that is poised for its own significant breakout. Something we've already traded and had some success with, and we'll trade it again. So let's go ahead and get started. Today is Monday, October the 14th, 2019. This is the market outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. We did roll back down a little bit in terms of these short-term sentiment indicators. The momentum line dropped back down to extreme lows. This is like the third extreme low during this pullback. In this case, really coming off of yesterday's or Friday's high point, but still holding this gap. We'll take a look at that here in just a second. The near-term line also rolled over, but still in the upper half of the chart. But that's a little red flag there. When you look at the long upper shadow and the near-term line not getting into the upper reversal zone again, it's really kind of unable to really get going to the upside. Keep in mind that every pullback here has been progressively getting weaker, just like every rally has been progressively getting weaker. You see how big this intermediate line run was, this one, and then followed by this third one. Well, every pullback since has also been progressively weaker and shorter and smaller, with, in this case, the intermediate line and you're getting really deep here, not getting so deep, a little bit more protracted here, and then not getting deep at all here. So it seems like we're kind of consolidating. There is a little bit of an upward bias, but it seems like we're kind of consolidating here with these equal to lower highs, higher lows with this blue line here. And you can draw whatever kind of blue line across those two peaks that you want to as well. Now the question is which way we're going to break out. I'll take a look at some more charts here in a second. I've got a couple of Fibonacci lines drawn on here. Let me zoom back out to the 6 month. So this intermediate run that we had, the second one, that we bounced, that we had pulled back down to the bottom of the Fibonacci retracement zone. We bounced back out of it here on September the 5th, broke out of it on September the 5th. Did not get up to a new high, rolled back down, fell back down into it here on October the 1st, and then kind of meandering around here, getting back up above the 23% Fibonacci line on Friday, even with the long lower shadow. Then there's a second set, which is this near-term rally that started this intermediate run. Well, essentially is the intermediate run because it only had, a few near-term rallies, and that was the most significant one. And so this intermediate rally, you can see we have not gotten above its 23% Fibonacci retracement. So we kind of need that to get going, really get going to the upside. And I've said before, we probably need to get above this 2988, 2990 level before we can really get going to the upside, getting above 3,000 and getting through these highs, whatever you want to call that kind of pattern, ascending triangle pattern, long-term head and shoulders, but whatever you want to call that pattern. If we're going to break to the upside, we need to get above this 2890 level, which would clear both of these Fibonacci retracement levels, the top end of the bigger zones, and which signals that we're getting going again. Both of these, actually, this pullback down to the 62% Fibonacci one. This pullback got all the way down to the 78% Fibonacci retracement. So these are some pretty deep pullbacks and makes the rallies a little bit harder. So don't be surprised if we don't fiddle around here on the intermediate line, getting above 50, below 50, throughout October before we really get going. Before the market gets going, we might pull back down toward filling in this gap, bring that intermediate line. Now you notice on the Dow, the intermediate line is back above 50. So you do have the dark green shading and the dark green line. The NASDAQ, you almost have, like the S&P, the dark green shading and the dark green line. And then the Russell still lagging. So this really needs to catch up too. So there's some factors that we kind of need for the market to really get going and it's really not. Now, the benefit is if we do fiddle around here and the intermediate line does kind of go back and forth to the downside, to the upside and downside across this 50 level, you'll notice that, while there is a little bit of resistance above us, there's much stronger support below us. So, if we do fiddle around, and there will be people saying, well, you see this trade war and the trade deals weren't bullish, and recession. That's not. I mean, there's going to be strong support below us. So we're probably going to, continue to work around. You can even on like the Ichimoku cloud and the trend strength indicators here. You see that, the bullish moves have these. Here's the 3 intermediate bullish moves, right? And you see how they've gotten progressively smaller. But you see the bearish moves have gotten progressively smaller too. And we're above the cloud on the 1-year chart. If you look at the weekly chart, we are also above the cloud. In fact, we're easily above the cloud. And we're easily above the Tenkan line, this green line, as well as the blue line. So, and then in the midst of a strong bullish weekly trend. So that kind of puts it in perspective of like, yeah, we're consolidating right now, and we're poised for a breakout. And right now, the outlook is bullish. The bias right now is bullish, according to some of these indicators. And like I said, according to the Bollinger Band, especially the point of control and most of the value area. As you can see here, it's in the upper part of the value. That little resistance above us and much bigger support. The point of control is well below us. I mean, everything. So it's poised to break out to the upside. It's just, it's not going to do it in a day, and it's not going to do it on the phase 1 announcement. It's going to be, as you can see, we've been consolidating for months, literally for months, with these smaller bullish and smaller bearish moves. One of these days, it's going to have a bigger bullish or a bigger bearish move, one or the other. And of course, our expectations are that it'd be one to the upside. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video that will notify you when these videos are posted. Hit the thumbs up icon down below the video too. We ask that for 2 reasons. Number 1, that lets us know that you like the video. Number 2, it tells us you want us to do it again tomorrow. So if that's the case, if you want us to do the video again tomorrow, let us know. 1 click down below. You can do that right now while you're watching. Also, while you're down there, comment. What did you get out of the video today? We'd love to hear that as well. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. You can click on that link to subscribe for free. That gets you access to our Market Outlook forum, online forum community, as well as different sections on our blog, like our market commentary section and other webinars that we do. Follow me on Twitter for more content in between these videos from day to day, and join our Facebook group our Market Outlook Facebook group that we've created. Also, if you're watching our video on our blog, we invite you to engage with us on social media, like today's Market Outlook tweet and Facebook post. Again, the more you do this, the more these networks will promote our content to the top of your timeline, so you don't always have to be on them every day looking at them. So we try to make it really easy for you. Just hit this little heart. It opens up a new window. You click that like button. Hit that image. It takes you to your Facebook account. You can like it there as well. Again, the more simple engagement, they'll always promote our stuff to you. Not all of our followers see our content because they don't do that. That's the way their algorithms work. They only show you the content of the accounts that you engage with. So we try to make that easy for you, like I said. Also, too, we have our class schedule up here on the top right, our upcoming classes. Remember, you have access to all these classes with our monthly plus subscription. There's a link right here with more details on that. And if you're interested in watching these trade ideas as we put them on in these videos, the Market Outlook and the Market Outlook live videos, we continue to manage those trades all the way to the close. So it's one thing to just put on videos and say, hey, do this trade, do that trade, do this trade. But we go beyond that and actually manage those trades. And like I said, our plus subscribers also get access to those videos as well. All right, well, back to the charts, and we'll take a look at the long-term chart, the weekly chart. Now, keep in mind that the week has just started, but you can see a big transition candle. They tend to be bigger on the downside than they do on the upside. They tend to be a little bit smaller up here. But a big transition candle after only a couple of weeks of pullbacks, again, you can kind of see how smaller they're getting, both to the upside and the downside. So kind of setting up. And again, positive momentum suggests upside breakout, not necessarily a downside breakout. Otherwise, had we been like flirting with the 200-day moving average, or the 50 had been flirting with crossing below it, like it actually is on the Russell, right? So we're still in death cross mode for the Russell. The Russell's been unable to get going here, and that's why the market, it just really hasn't been bullish from a risk appetite standpoint. The markets just haven't been really bullish here. But you can see we're starting off with a bullish candle this week, and we have, the open was 29.54, so we're at 26.66. The low today, if you look at the regular candle, the low today was 29.62. So as long as we stay above that 29.54 area, then we'll avoid a lower shadow and start and maybe have the beginnings of a bullish. I don't think that will happen here. I actually think we'll probably get a little bit more, another transition candle, because we'll get some weakness here probably tomorrow, Wednesday, before maybe some strength into the end of the week as we really start getting into the earnings season. If you take a look at the 3 green arrow chart for the S&P 500, you can see we're back to 3 green arrows with a green line. So that that's a positive development. We're not there on the Russell 2000 though. We only have 2 green arrows. We're not above that moving average. We don't have the 3rd green arrow yet. So perspective on that one. You can also see too on the 5-year chart. We do have the 3 red arrows. We are above the moving average, but we do have the 2 red arrows. Excuse me. So from a 2-line perspective, you can see, like I said, on the daily chart, 3 green arrows. The MACD is close to crossing above 0. The stochastics already has crossed above 50. So good developments from that perspective. On the 5-year chart, you can see how we do have the red histogram, and the stochastics is below its moving average, even if the MACD is still above 0 and the stochastic still above 80. You see the consolidation here as well on the stochastic indicator. Let's take a look at the DMI here really quickly. The DMI for SPY, the positive line, the positive directional index is above 25. So it actually is where you want it to be. What we're missing is the negative directional index getting back below 20, which it hasn't yet. This pullback, we got up above, and we never did get below 20 on this one, and it's still above 25. So that's why it's like you're not bullish until you really, you on one hand, you get the positive directional index above, but the other hand, you need the negative directional index dropping back below 20. So kind of keep our eyes on that as we, figure out when and if this new bullish intermediate run that looks like it's trying to get going actually does get going. All right, now let's take a look at the intraday chart, and we still haven't filled in this gap. And I tweeted this out. We talked about this in my Friday technical analysis class. We talked about the idea, and I mentioned this in Friday's Market Outlook video, this idea that we'd come down, this kind of inverted dead cat bounce, so to speak, that we'd at least come back down towards the open, which we finally did at the close on Friday. And I also mentioned too in my Saturday Q&A session with our premium subscribers that expect us to get filled in here, and we have a little weakness here today. Look at all the volume we have above us versus below us. So right now the path of least resistance, but the nice thing is there is some pretty solid support down here towards 294, a little bit below. And you still got the whole value. You're still easily in the value area. So I don't expect us to fall off a cliff. But I do expect a little bit of a pullback here, some continued weakness early this week before we do turn things around later. And if you look again at the 3 green arrow chart for SPY, you can see the volume dropped off considerably down to 40.5 million shares trading in the trading range at 1.1. So that's a really, really small range. It's actually going to be right here. That's a really small range, and it's a very, very small amount of volume. Here's what it looks like. The volume way down to 40 million, so way down there, and their trading range at 1 point also way down there. So I mean those are numbers that bring these lines down. And remember, as these lines come down, it's bullish. It's not bearish or bullish. See how these came down on that bullish run, they came down on that bullish run, and they came way down on that bullish run. So we've progressively gotten, to different highs on each level, and we're about the same level of height now as we were during this pullback, even though the pullback has been less. But as I mentioned before, from a trend perspective, the declines have had a lot of volume, and the bounces haven't. So, but until Thursday and Friday, and you can see that the advancing volume really picked up, in a good sign that we are building this base, with this high trend average being at levels where we typically bottom out, and start working our way back up to the upside. Take a look at the volatility index as well. The volatility index now has dropped below 50 at the same time, 15, excuse me, at the same time that the VIX itself has dropped below this 90% mark of the VIX 3-month, the 3-month VIX. So that's a good sign too, from a bullish perspective. We're not quite entrenched there, but the last time we fell below 90, over here we did not fall below 15. So that's why it didn't really take hold. Now the question is, well, this is a lot lower. The VIX is a lot lower now, so there's a good opportunity for us to really take hold inside of this bearish territory. Even over here, when we dropped below on September the 5th, when we dropped below the 90th percentile, we did not drop below 15 for a while. So again, a much better scenario now than we even had on that September 5th breakout on the market. You take a look at the daily chart and you can see that the volatility is just progressively dropping lower and lower and lower. And now you just end up, as you get below 15, you just end up with some really small moves. But we had the big move to the upside, even on a weekly basis. You can see we had a little bit of a long upper shadow, and now 2 weeks in a row, volatility is starting to drop back down. And we've had our bounce in volatility. It didn't produce a surge. It produced as much of a surge as it did, but not one that you would expect a market sentiment pullback, just a intermediate pullback, and that's what we got. And now we look for it to get back down to these levels, and which coincides typically with the beginnings of a bullish intermediate run, which we have on some of these other, some signs of it on some of these other indicators as well. So to review the technical outlook, we have the beginnings of a bullish posture. We're not there yet. It's still kind of shaking out. I do expect some weakness still this week. Like I said, earlier than later. Then I expect us to kind of bounce up and down around this intermediate line as we are consolidating, with lower highs and higher lows, until we get a breakout, until we get an intermediate run that's bigger than the one way or the other than the previous one, as we've gotten progressively smaller. And again, the expectation is, based on the trend and a lot of these other longer term indicators, that breakout will be back to the upside, especially considering the seasonality and a bunch of other factors. So what do you think? Do you agree with that technical assessment? Do you disagree? Click that link popping out in the top right corner of your screen. Opens up a poll, and then you can vote, either agree or disagree. If you click disagree, comment down below on what you're seeing that will suggest something different than what we came up with Outlook here. Again, everybody's got their opinions, and I'd love to hear your opinions, but what's more valuable is what's driving that opinion. What are you seeing on whatever indicator you look at, whatever charts you look at, that would suggest something different, and feel free to share that in the comment section. Interestingly enough, last week was kind of a bad week for bonds and gold, and then they kind of a little bit of an oversold bounce today. Considering there's no market drivers, the market didn't move one way or the other significantly, so that sets up the environment for, as you can see, if I were to go back and include last week, so we'll go back here to the 7th all the way through the end of today. So we'll include last week, and you can see that bonds were oversold and gold were the most oversold going into today, and they rallied up the most today. So that's not surprising in the least bit. If we just take a look at here today, then you'll see that crude oil produced the weakness. Big drop in crude oil there, while we had even with a strong dollar. And those are some charts that we've been keeping our eye on. The dollar had pulled back towards support, and so far is trying to figure out, maybe the beginnings of a morning star candlestick pattern. The weakness in crude oil is significant in that we're still not able to get going either to the upside, and that's this is a very important support level for crude oil. Breaking below here, you can see there's not very much support below that level. The point of the value area is down below there, 50 and 3/4. So you break below that 50 level, and it's a way to the downside. Even with this little drop that we had in the Christmas, that was just very low volume to begin with. So I mean, if you go out a few more years, you can kind of see how far down we can go. There's some volume in this area, so I don't expect us to break below support. There's more significant support in this area too. I don't expect that we'll break down through that, but this is an important level that you would need crude oil to hold. And the nice thing is, from a bullish standpoint, we are closer to the low. Then we got a very low margin of safety, so we're sitting right on the support. So that gives you opportunity for movement to the upside, and obviously. It's hard for crude oil to get going to the upside without stocks following as well. There's a risk. There's a correlation there from a risk standpoint. If you take a look at the long-term view, it's just been so sideways here throughout most of this year, like the Russell 2000 has been. You can see it's actually in a death cross environment itself and has negative momentum. It's actually increasing negative momentum according to the PPO, but still very, very light, small. Like the PPO is not very big. When you put that in perspective, coming off of pretty significantly bearish PPO here, we've essentially been consolidating as well. On the other hand, you look at the yields, and you saw how bonds rallied today. Did a little bit of an oversold bounce today too, and look how bearish yields have been, and they're still coming off of these lows and are trying to figure out some kind of base here. And you can see. Get above 1.86%, which is that 23% Fibonacci retracement level. Then we're going to have a bullish bias for a little bit for yields. And that, I'd imagine, would also coincide with an increase in risk appetite heading in to the end of the year. But you can see not so much today, down 1% today. And you look at TLT, you see how bullish it has been. And like other times when it's been this bullish, it's starting to work its way to the downside, and a break of 140 will be a significant perspective. We'll be really breaking below the 141, but getting below 140 would mean that we are breaking below the 50%, 50-day moving average, and filling in the gap, which it tends to do when the PPO is this big, and you break down, right? You break down in, you start to fill in that gap. You break down in, you start to fill in that gap between the two. So that's the expectation on long-term bonds, and for that matter, even gold has been extremely bullish, and not as much as long-term bonds have been, because that it was so bullish heading into during this weak dollar environment. It has had a little bit of a breakout here above this pattern. I don't think that it's done like making a run. I just think it's going to be harder and it's going to be slower. It's going to get back down to where it's like slower momentum like this, because if the dollar is also in its own bullish trend, which you saw here, as you saw in the daily chart. But if you see here on the weekly chart, you can see it's kind of on a slow growth momentum golden cross environment itself, with the 50-day gradually moving up there above the 200-day moving average, with the dollar itself grinding its way higher as well and trying to get above that Fibonacci retracement. Again, it would have to really get above 100 for it to really kind of make a move, because that's the breakout of the Fibonacci retracement zone that we are, in this case, reversing. This retracement zone is based off of the downward move, so this would be a reversal retracement zone. Breaking above 100 would mean that we're going to have that kind of a move. How far up depends. As you can see, there we go. As you can see, a move up to, this is not like an extreme overbought condition for the dollar. There's opportunity for it to make a run, and considering other past, the late 90s when we had a mid-cycle adjustment and a strong yield spread between the United States Treasuries and European Treasuries, that was also a very strong bullish environment that pretty much led to that peak eventually that you see over here in the U.S. dollar. From a sector rotation standpoint, again, you can see you have your safe haven areas that have been bullish. They had a bad week last week, and they're bouncing up a little bit today. In fact, let's just take a look at the same time frame. We'll go down to October and go through last week into today, and see. You can see utilities, real estate, staples. They had a bad week. They had the worst week going into today. Materials and industrials had the best week last week, and with a little bit of technology as well. Well, there's your materials. These safe havens still lag behind. Real estate bounce, financials bounce even with the drop in yields. And then the rest of these kind of other major sectors that we want to rally at least outperformed. If not, they didn't rally, they didn't close with gains, but they outperformed. And again, that's about as bullish of a pullback as you can get, really, and shows that this is just a little breather, like that this isn't the beginning of a bearish run. Otherwise, we'd have more risk, safe havens at the top. This is just simply a little bit of a pause breather and a lack of a news day, and really the only news we got was a little bit of skepticism about the trade deal, and it didn't spark this big move back into safety. And that brings us to our trade idea of the day, and it's back on a trade that's about to be done in October here on a previous Market Outlook trade. And again, I do discuss these trades all the way to their close in those Market Outlook live videos. So we've been managing this trade for a while, and it's been doing really well, and it's close to wrapping up. Short put trade, financing the cost of a long vertical spread. Well, now I think NVIDIA has got the nice opportunity here to have a breakout move. Now it's got a bullish pattern here, strong green line or dark green shading, green line. You take a look at its 3 green arrows, and you can see it's also got 3 green arrows, green line, even with a little dip in the stochastics, back to 3 green arrows and the green line. You look at its long-term chart, and you see that we are really close to a golden cross, and you see this big potential over here. You look at its Bollinger Bands, and you can see here on NVIDIA that we are really close to getting above the current, like this 1 year value area, which is going to get even more significant as this comes off and we trade more over here, because that volume is going to come off. It's going to show an even more significant gap in volume there. But you take a look at the weekly chart and look at this kind of gap in volume above where we're at back into this area. So there's a good opportunity for a pretty extended move in NVIDIA. We were a little bit more conservative because we hadn't broke out yet before. But with this trade, we can be a little bit more aggressive. You can see, for example, on its trend strength here, NVIDIA, that it's got the beginnings of a bullish posture on the daily chart. And again, the weekly chart, it's a little bit of a moderate. We're trying to break into the cloud as we break through these highs and potentially up and through. So you can see getting up above this cloud, as it's trying to do, will get you well above 200. And this trade that we've already done, we put it on during the Market Outlook live session here. You can see we did a here. Let's do. We did a 200. We sold a 200 call and bought a 195 call. So essentially, this is what it looks like. We did it for November, knowing that we have earnings right before that November expiration. So we didn't do a big. We only did a $700 risk here, and again, we only put half of that generally at risk, $350, for the potential of a $1,300 reward. So a nice reward to risk ratio. And you see that getting above 200 is easily within the realm of possibility for this. And in fact, if we make a run up above 200, it might be a situation where we say, you know what, let's close out the 200 short call, depending upon how close we are to expiration. If we can get out of it without a whole lot of extrinsic value, if we can sell, make most of that $372 and then roll that November call option out. And let it keep running. But even with that, and we can look for another trade at November expiration, of course, a different trade, but good opportunities to the upside, and this would be a good reward risk ratio if we're starting that move to the upside, which we can take advantage of later upon the actual breakout. Even if it's the earnings that fuels that breakout, we can take advantage of that with more of a directional play, considering that if it does make a significant move, we're talking up to 250, back up in this 250, 275 area. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link up there. It's popping out on the top right corner of your screen. That takes you to our Market Outlook forum. Remember, that's one of the perks of being a free subscriber to our site, as you can participate there. And let's keep this conversation going. So open up a thread with any questions or comments you have about anything I discussed in the video today, or if there's something I didn't discuss that you want my take on that pertains to this topic, of course. Open up any new threads there, reply to anybody else's threads, and let's keep the conversation going at marketscholars.com. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video, follow me on Twitter for more content like this in between these videos. Join us at marketscholars.com, as well as the Facebook group community that we've created for Market Outlook viewers. Have a great rest of your Monday evening, everybody, and we'll see you all tomorrow.